Joining us now is Adam Crisafulli from Vital Knowledge. Adam, welcome. So things market-wise, down a bit today, but seem pretty stable considering. But is all of the news and data being factored in here? I can't help but look at this economic news out of China and notice that Apple's still near all-time highs, and we're going to get FedEx in just a bit. It doesn't seem necessarily to be reflected.
No, I think for the overall S&P, the upside is certainly more limited than it has been. We've gone about 400 points since the last earnings season. I have a really difficult time envisioning it getting above about 1550 in the near to medium term. I do think, though, you have one more kind of big positive macro catalyst, and that is going to be an acceleration of disinflationary pressure in the coming weeks and months. You've seen in the last couple of weeks an accumulation of data, including today some of the PPIs out of Europe. The German PPI in particular is 1% in May. That's down from 46% a little under a year ago. So you're seeing a real rapid decline in prices. And I think that you're going to see further evidence in the coming months. That's going to alleviate a lot of pressure from central banks. And that's going to kind of give you one last positive catalyst. And then we're going to start to get into a period of time where disinflation is going to actually create some headwinds for corporate earnings. And I anticipate that being more of a fall type of an event. But okay. I agree with you. I think, we've come a long way. And so the upside is definitely not as appealing as it was.
So if that's the case, we don't know, no crystal ball. But if that's the case, if equities have had a nice run, maybe a little higher from here, similarly, interest rates have run a lot higher, maybe a little higher from here. Seems like a decent time to just assess, right? I was looking, at my retirement portfolio over the weekend. It's like, wow, the S&P 500 has had quite a run year to date. Baby boomers are overweight equities versus what's traditionally recommended at this point. Long term, you're supposed to hope to get around 7 or 8%, I think, on equities. If you don't have enough fixed income relative to what's usually recommended, should people be rebalancing, you think?
Yeah, and I think that's definitely a consideration as we head into the end of the quarter. The funds that have, pretty standardized benchmarks that they have to be measured against, there certainly could be an allocation out of equities, which have been very strong performers, and into fixed income, which is certainly underperformed. And then circling back to what I just said about inflation, if we are kind of at this peak and you're going to start to see an acceleration of disinflation, that certainly will be positive for bond prices. So I definitely think, and that is a potential headwind for stocks in the final weeks of this month, is a potential rebalance into fixed income away from equities.